Welcome everyone to our program on reverse mortgages. My name's Mike Thompson, the fellow that's been emailing you. And our presenter today is Richard Hoffman. I'm going to call him Dick because that's how I know him, but Dick has been in the banking business for many years and retired now, of course, and now we can tell the truth about things, right? So Dick, why don't I turn it over to you and let you get started?
Okay, well, thank you, Mike, and welcome everybody. I'm so happy to see everybody here this morning. My name is Richard Hoffman. I serve as the board president of RSVP, and I've been on the board for 10 years now this year, but my association with RSVP goes back to 14 years. I was a driver, I was a coordinator. And prior to my retirement, I was the executive vice president at the Stoughton State Bank here in Stoughton, where I reside. I spent 26 years there, and I retired as the senior lending officer. During that time, I also served as the lending committee leader with the Wisconsin Department of Financial Institutions, which was a volunteer position. But what it did is gave me an insight as to what the regulators were proposing and what they were looking at. And after that, I became involved in the process of drafting regulations for the new product in the banking industry called a reverse mortgage. And at the time, this came under the Federal Home Loan Administration. They had administered it and regulated it. But there were so many failures in the law when it first started that there was too much confusion. So at that point, it was being redrawn. I then served as an advisor with the Federal Home Loan Administration in Washington as a key member in drafting the consumer protection for this type of product. And then when we were all done, the law was signed by President Ronald Reagan in 1988. This product goes back to 1988. I have a lot of people from time to time telling me, I just heard about it in the last 3-4 years. I can't explain that other than what has evolved over the years. Originally, when this product became available to consumers, it was a product delivered to the consumer by your financial institution, who was regulated by the state and federal government. After it was rewritten, the product was endorsed by the state banking associations to be offered by mortgage lenders. And back in 1988, a mortgage lender was a savings and loan, that type of business. But as time evolved, private mortgage companies got into the business of lending money to consumers and making loans. And they technically were not regulated by any of the federal authorities. Moving through time, this product suffered a lot of bad reviews simply because, as I said, it was new, and a lot of mistakes were made, not only by the regulators, but by the lenders also. Taking you forward to the early 1990s, I was contacted by the Federal Home Loan Administration and the Wisconsin Department of Financial Institutions, which is the regulator for the federal government in the state of Wisconsin, and asked if I would, as a banker, process the first reverse mortgage loan. They had someone that had agreed to go through the process as a sample, and the whole thing would be terminated after the process was done, so that we could see how it worked from a banking perspective. So I was the first lender in the state of Wisconsin to process the first reverse mortgage loan application, which was approved and became the model for all banks in Wisconsin. It's called a reverse mortgage loan, and that's self-descriptive, although it's misleading. what I like to tell people about a reverse mortgage loan is it's a mortgage loan that increases the amount of debt you have as long as you have the mortgage with your lender. It is not a cash out situation where you can, it's not an equity loan where you can go borrow money against your equity. There are several products out there in the financial industry. There's a home equity loan. There's a home equity line of credit. I'm not going to talk about those today. What I really want to do is focus you and get you a clear understanding of what a reverse mortgage, the do's and don'ts. I've had a lot of experience in this. Mike and I were talking before we got on. I've seen and experienced a lot of people who've gone through the heartache of losing their home through foreclosure, because when they got involved in this process of a reverse mortgage, neither the borrower nor the lender knew exactly what was going on. So that's what I'm going to try to do here for you today. And I'm going to try to give you a brief review of what it is, who should use one, and what to look out for. And then if we have time at the end, I know there's probably going to be some questions. I can't guarantee I can answer all of them. Okay, a reverse mortgage loan is not a home equity loan. It is not a home equity help loan. That's a different product. Simply put, a reverse mortgage is for homeowners. You must be the owner of the property and reside there. The first qualification is you have to be the sole owner, or you have to have a co-owner, such as a spouse or another person living in on the property. So you have to be the owner of record. You also must occupy the home full time. It's not a place that you could spend 3 months in the summer in Wisconsin and go down to Florida for the other 9 months. And there can be no liens or existing judgments against the property. In other words, if you haven't paid your real estate tax, or you had a lawsuit filed against you and the court awarded a lien against your property must be free and clear. That's the term I use. Free and clear of any encumbrances. Okay, given the fact that those things exist, one caveat here is that if you have an existing mortgage on your home when you apply for a reverse mortgage, that is okay if part of the proceeds of your new reverse mortgage will satisfy the existing mortgage that you have on your home. So that when you get the proceeds of your reverse mortgage, you pay off the old first mortgage, and then the only mortgage on your home is your reverse mortgage. Once you are interested in using this, you should be aware of the fact, or people should be aware of the fact, that there are certain reasons why you should not use reverse mortgage, and there are several good reasons why you should use one. I'm going to cover the reasons why you shouldn't first, and then we'll go through the process of what the process is for getting a reverse mortgage. You should not encumber the equity in your home for the purchase of consumer goods such as an automobile. And here's the simple equation I like to tell people about. If you buy a car and you say, gosh, I'll just put it, I'll borrow money against my reverse mortgage, and then I won't have a monthly payment, etc., because of the car will last you 3 to 7 years maybe, and then you have not paid that off because it's on your reverse mortgage. Now you're going back 3 to 5 years or 7 years from now, same thing. You need another car, throw it on the reverse mortgage. What you're doing is just increasing the debt and reducing the equity that you are gaining. So that typically gives you an idea of what you should not be doing. What should you use a reverse mortgage for? You should use a reverse mortgage for any expense, personal expense, that is a long-term debt that is causing you to reduce your cash flow because you have to now make another large payment I use an example of an unpaid medical bill, a large medical bill. And the health institution is going to probably make payment arrangements with you that you have to pay $200 or $300 a month until your $10,000 bill is paid off. Well, that $200 a month is in addition to what you're paying on your reverse mortgage. So you might want to get rid of that altogether and combine it and put it into your reverse mortgage and for the $10,000 and pay off the health institution, because your reverse mortgage is amortized, spread out over a period of 15 to 20 years. Your monthly payment is not going to increase from what it was prior to that. You should not, absolutely not, use proceeds from a reverse mortgage to invest in the stock market or any other investment that there's a high degree of risk. And the reason I say that is, I don't know if any of you do any investing at all, but I'll give you a very simple example. Your best friend comes up to you and says, I've got a hot tip for you. I just bought some shares in ABC company for $10 and about a month ago, and it's now up to $30. I made $20 on a $10 investment. That's all real nice if the investor can weather the financial ups and downs of the stock market, but you're dealing with a mortgage here that's going to run 10, maybe 20 years. And what likely is going to happen through the lifetime of you owning that stock for $10 and it went up to 20. We all know that when stocks go up, they also come down. And you could not afford to have the worth of that stock, which is encumbered by dollars you borrowed on your home, to be negative, because now you're going in the wrong direction on your reverse mortgage. The same thing is true with buying another piece of property. This is not intended for you to speculate in any other type of real estate investment. This is a very personal product that is out there for people who have legitimate reasons. And here are some of the reasons why. You may have personal credit where your monthly payments equal or exceed what your house payment is. And you've now lost the income of one of the spouses. So the best thing to do would be to probably tack it on to your real estate, because here's the example I use. You've got a house valued at $100,000. You've lived there for 15 years and the payment, your balance is $50,000. So you've got a $50,000 equity sitting out there. And rather than go and get a personal loan to pay off all of these bills or to put it on a credit card, which is a different story, what you should do is sit down and talk to a lender or someone with the experience and say, we've got monthly bills totaling another $450 a month, and it's putting a strain on us now because my wife or my spouse lost their job, and therefore we're now down to one paycheck instead of two. I've got $50,000 worth of equity in my house. What do I do? Well, here's the typical example of why you should use a reverse mortgage for this situation. Let's assume you've got $10,000 worth of credit card debt, and the payment is exorbitant. The interest rate is 18 to 24%. Your reverse mortgage rate may well be the market rate for whatever they are, which might be anywhere from 4 to 7%. So you can see the 11% in interest by adding it and using the equity in your mortgage. Now, it's called a reverse mortgage for a very good reason. Let's use an example of a reverse mortgage loan of $75,000. You go ahead and you get it, you pay off your credit cards and everything else. With a reverse mortgage, you do not have to make a payment. What happens is each month, the lender will charge your account the amount of interest due for that month at the rate of interest that they're charging, and add it on to your original loan balance. So what happens In a normal mortgage, every time you make a payment, so much goes to interest, so much goes to principal, and your balance on a normal mortgage is reduced. On a reverse mortgage, it's just the opposite, and that's the reason it's called reverse. You don't make a payment, and so what happens each month, the lender adds to it the interest. So your equity is going to shrink each and every month. Now you have to think about your situation in the planning, that how is this going to help us in the future? Some people say, well, I get an annual bonus at my employment, and I'll put that and give that to the bank and reduce. That's one way of saving so that you don't lose all of your equity. But the key thing here is, after so many months and years of doing nothing but let them add interest to it, you could likely end up owing more than what you borrowed. And that's a problem, because all of a sudden your monthly payment is going to go up every month to cover the increased balance at the interest rate that you are being charged. So the longer you keep that and you don't pay it down at all, you let the bank add the interest on, that could become a problem. The other thing is that you are required under the terms of a reverse mortgage you must pay the real estate taxes and homeowners insurance and provide them proof each year that it's been paid. You cannot ask for an extension of real estate taxes for whatever the reason. And some borrowers, some lenders will ask you to escrow 1/12 of your tax and insurance payment. So that could also give you a monthly cost, or they will add it to your reverse mortgage. You see, what happens with lending money is that it's not like building an automobile and you have a fixed cost, etc. A lending institution uses a depositor's money to lend out. Now, the depositor brings in $10,000 and the bank pays him 3% interest if he leaves it there. They turn around, take your $10,000 and lend it to the first person who comes in for a car loan. They charge him 9%. The difference is what the bank's making. That's how banks arise. And that's why it's to their benefit to keep adding the interest to your loan, because it's an income stream for the lender. Not going to go too far into that. So number one, you've got to have the loan appraised by a certified appraiser. There is a charge for that. In today's market, I would guess that a certified appraiser approved by the lender could charge you up to $300 to $350, $75 to make a home appraisal, because what they normally do today is they also do an energy audit. That's required by some municipalities so that they can get that into their records. There are other things that they might be appraising: outbuildings, the land, in addition to where your residence is sitting on. You've got to have proof of homeowners insurance prior to getting the loan. And the one final thing is, and this is what I like about this product, when we worked and put the product together at the federal level, we were all bankers. There were 16 bankers in Washington, D.C. putting this together. And we all 16 bankers and the federal regulators agreed with us. We said that there must be a counseling approval prior to making. The lender must provide you with or ask you to get a certified counselor in financial lending. And what that means is that someone who knows about the product and the industry, the financial industry, can sit down and explain every detail of this product to you so that you have a full understanding before you go any further. And then they will write up a certification for your lender that you have a complete understanding. That removes a lot of what I call bad decisions by people Well, they never told me that when they closed. I wasn't aware of that. You sign a statement that you understand what you're doing when you're done with this counseling. You may be subject to a loan origination fee, and most of these fees, by the way, will be taken out and paid from the money that you're getting by increasing your mortgage. That's really not the way to do it, because here are more add-ons to your mortgage balance that the bank is going to be charging you interest on when you make your payments. There's also legal work. You must have an attorney represent you at the closing. And then there's the recording fees for the recording of your mortgage, satisfying an existing mortgage of record, etc. Now, that's the basics of what I like to say is, I hope I've created questions in everybody's mind, because when I was doing these products in the financial, in the bank, when I was in the business, it took longer to explain after I got an application from an individual for a reverse mortgage. It took longer to explain about it than it did to actually make the reverse mortgage loan. And I saw personally a lot of foreclosures that came up, and when they went to court to try to save their property, they told the judge or whomever it was that I wasn't told that at the closing. I wasn't aware that this was going to happen, that I was really putting myself at greater risk. The judge is going to tell each and every person in these cases that there are certain things that the lender did that the law required. So the lender did not try to put anything over on you. And what the reverse mortgage product created in the legal industry was a saying that the judge will tell you that ignorance is no defense in a court of law. In other words, when it comes right down to it, you're the person that wanted the product, you're the person that borrowed it. And now, because you didn't understand everything, you can't blame everybody else. And I think that's the way you should look at it.
Dick, let me jump in there real quick.
Sure.
Why wouldn't a person just go out and get a cash, just refinance their home and get some cash out?
Well, some people will do that. But the problem, Mike, is that type of loan increases your monthly mortgage payment. A reverse mortgage loan, you don't have any payment. Your reverse mortgage balance goes up. They add the interest to it every month, but you don't have to make a payment. So the idea is you have to have a substantial amount of equity, and that's why seniors, because they've lived in their house for 20 or 25 years, they paid so much for it. Inflation has now brought the value of that home up to triple what it was when they bought it. So they're sitting there with $150,000 worth of equity. And if they went out and refinanced and just got another mortgage loan and borrowed $50,000, they're still going to end up with a monthly payment. But using the reverse mortgage allows a senior, and here's the scenario that I looked at that I used to see all the time. A family, the gentleman is 61 years old. He wants to retire from General Motors or wherever it is at age 65. They have an opportunity at this point to add a sunroom on the back of their home and change the garage from a 1-car to a 2-car. But in 3 years, his income's going to go from what he's earning at General Motors down to what his pension and Social Security is. So it makes sense for that couple to do a reverse mortgage, because it literally puts more cash in their pocket, and they have a substantial amount of equity that they can afford to let that build up, because when they're 70, their plans are to sell it anyway and pay it all off. When they pay it off, they're still going to end up with a substantial with their equity in their name. So it's a win-win situation, but it depends on each individual situation.
We had a question from Katie. says, can you explain what might happen if a consumer has a reverse mortgage and then falls behind, rolls over property taxes? Now, what if you don't keep up your taxes on the thing?
Well, the same thing happens with a regular mortgage loan.
Mhm.
You're going to be foreclosed. There are very few protections when it comes to, unless you have a legitimate reason and you can go before the court and ask them to defer. And medical is one of the main reasons. Catastrophe or disaster. We're looking at everybody down in Kentucky. You take a look at that picture down there, and I would guess 50% or more of those people had mortgages. How would you like to be the lender and go out and take a look at what your house looks like now down there? These people aren't going to pay anything any further. There's no foreclosure remedy. The government has stepped in, and this is one of the things that a lot of people don't understand during a tragedy. When the government approves disaster funds, they come in and put a stop on foreclosure against people because of the tragedy and the disaster. These people don't have to worry about paying for something that they don't have anymore. But in your case here, and it's a good question, if for some reason you get behind on your real estate taxes, the first thing you should do, and I'm telling this you as a retired banker, the first thing you should do, and it's really something that is in your favor, contact your lender immediately. Explain to your lender why you were not able to pay your insurance or taxes, or why a judgment was rendered against you, which is a lien on your property. That lender, once he knows that you are letting him know that he has a problem, will work with you. 99% of lenders don't like being in the position of getting a notice from the court. There's a foreclosure action pending by the county because you didn't pay your real estate taxes. That getting to the lender immediately when you have a problem, the lender can probably say, well, you know what? You're $5,000 behind on your real estate taxes from 2 years ago. Let's advance more money against your reverse mortgage and pay that. But once it gets going to foreclosure, if the county forecloses because they didn't get the real estate tax, once it goes into foreclosure, the picture changes dramatically. You now become a borrower who has not taken care of an obligation. You've gone from a very nice customer at the bank to a person that didn't pay your real estate taxes and then didn't even come in and tell the person who has the biggest interest in your property that you couldn't do it. The answer to all of the questions about what happens if is most lenders, and I say this, most lenders today appreciate the fact that when you have a problem, whatever it is that's going to cause you to miss, delay, or not pay, would love to hear from you the minute that situation exists so they can try to remedy it before it gets out of hand. Now, I said that here's one question that I probably know will come up. You can get, let's assume that you're living in your home and your brother is, but and he helps pay the rent, he pays the mortgage, pays the mortgage payment, utilities, etc. But you're the homeowner. The title of the property is in your name. If you default on that reverse mortgage, he has to get out. Even though he's got a vested interest, I pay, my agreement with my brother was I pay half the real estate tax. It doesn't make any difference. You're not the owner of the property. If you have when you get a reverse mortgage, you may have a situation where the spouse does not want to be the borrower. So husband or wife, the husband or the wife says, I'll take it all in my name. And that can be done. But the only person that is liable is the person who signed the reverse mortgage. So if a default occurs, the non-borrower who's living in the property, which could be a spouse, has to vacate the property. I just saw a question about can you borrow to pay real estate taxes? Depending upon your situation, probably yes. You know, real estate taxes become a priority lien on property. And when I say a priority lien, it becomes the first bill that has to be paid when the property is sold. The lender is second. But you can't transfer property in the state of Wisconsin with unpaid real estate taxes. And there's a good reason for that. We're all taxpayers. If people were able to default on their property because they didn't pay their taxes, our taxes are going to go up all the time because there's too many people not worrying about paying them. So the law is designed to make everybody pay their fair share, and the law allows the state to get their money first. Okay, I do want to mention, and
before you go, Richard, we had one, Ginny asked, should I use a reverse mortgage to cover my spouse's nursing home expenses?
yes. Again, depending upon the situation, if they're temporary expenses, in other words, my husband was put in a nursing home for rehabilitation, but will be coming out soon, I would not use a reverse mortgage for that. I would ask for terms, you know, if you don't have insurance for nursing home care, I would go to the nursing home and say, well, I owe you, you know, he was here a month and I owe you $4,800. Can I pay that off with a monthly payment? If your spouse is going to be permanently in a nursing home and you don't have nursing care insurance, there are some federal benefits available to people who are on Social Security for health care. But what you have to do is sit down to determine he's going to be there forever, and it's $3,000 a month. Now run the figures real quickly in a year. If you have $70,000 sitting out there in equity in your real estate, and you know that he's going to last maybe 3 years, do the math on it. And rather than have the nursing home place a lien on your property for unpaid health care, pay out of the substantial equity by using a reverse mortgage. You have to do a lot of what if when you do it. Now, as I say, I know people that have used reverse mortgages to buy a new car every 5 years. They never own a car, and their debt never goes down. Your debt will not go down unless you happen to become, let's just assume you have a family member that passes, you've got a reverse mortgage out there, the family member passes, and in the will, you are the benefactor of the $20,000 from that will. Personally, what I would do is I would take that $20,000 and pay down my reverse mortgage. It's going to reduce my amount of my monthly interest. It's going to create more equity for the next time I have to use the mortgage to increase it again. Mike and I were talking, and I want to stress this more than anything. A reverse mortgage is a great product. Even though you'll see Tom Selleck and other people on television pushing this product, they have. When was the last time you saw a TV commercial for a reverse mortgage where they said something to the effect that you're going to owe more every month with this product, but it's for everybody? They don't tell you that. I hope that's the one thing that you understand. Now, let's get off of reverse mortgage just for a minute here. A home equity loan. The difference between a reverse mortgage and a home equity loan is the same situation exists but you have a need for $20,000 for the husband's health care, whatever it is. And you have a lot of equity in your home, but you have cash flow from investments, retirement accounts, or earning potential to be able to pay that off over a certain period of time. But if you're going to go out and borrow money for that particular debt, you're going to pay substantial higher interest rates. So the cost of getting that is going to be pretty high. But you can use a home equity loan, which uses your property, the equity in your property. It's not a first mortgage, it's a second mortgage. And that's going to be a lower rate, and you can pay it off. And now you create more, you're back in an equity position with your home. So I like to tell people that, what do you need the money for? How are you going to repay it? And how does this affect your cash flow? I guess I think I've covered everything that I wanted to as far as the do's and don'ts and what is a reverse mortgage. I know there's going to be a lot of questions, hopefully, and I'd be glad to answer those that I can. Want to just raise your hand or?
Yeah, please feel free to unmute yourself. We've got a couple of nice remarks here. Connie, who I believe has plenty of experience in the financial field, remarks that a senior may not have adequate income to get a refinancing on their mortgage, right? And so that's a possibility. If anyone in the audience here has had experience with clients or personal experience with these, I'd love to hear from you.
Yeah, anybody have an experience which was an unfortunate experience with a reverse mortgage, or a client or a friend or anything like that? Care to share it?
This is Jim. I know that we've talked to people without identifying any group of people, that it has been a problem for certain groups of low income seniors in Wisconsin who apparently lost their homes. I know that you've given programs about that. That it has been a negative experience for certain low income people who saw it as a way of either getting out of debt or just having better cash flow. I guess that would be the same thing, but so I know it has been a negative experience in several cases that I've heard of. I can't get more specific, but you know what I'm talking about.
Well, yeah, please keep in mind that one of the requirements for reverse mortgage is you must have a counseling with a certified individual who is certified in reverse mortgages. That's the person that's going to sit down and go through the cash analysis, the cash flow, what you're using it for, and he's going to come back and say you don't have enough money to qualify, so don't do it. That's one of the keys. When you get a home equity loan, a regular home equity, that's not a requirement. The only product that has that counseling requirement, and they have to certify that they have recommended you and have gone through your finances, the reason for your borrowing, how you're going to repay it. They sort of are the one has the final say, the counselor does.
Dick, is that the counselor independent of the lending agency?
Definitely.
Yeah.
Definitely.
And that counselor is functioning as a fiduciary or just an educator?
He's functioning as an educator because it's required by the federal government.
Mm-hmm.
He cannot act as a fiduciary because he doesn't have any contract or any affiliation with the borrower and the lender,
Mm-hmm.
the third party, and that's for a good reason. I know what Jim's coming from here is that, I'm a counselor for XYZ building a loan. I qualify everybody. because that's my job with them. That doesn't exist in the reverse mortgage. And that's why the counselor requirement was so important when this, now, let's say this, and I don't want to get myself or you in trouble, but there are lenders out there, and you get them on your computer, you get them, see them on television, you get mailings. There are lenders out there who are not certified by the Federal Home Loan Board. So what they're peddling is a reverse mortgage that is an unqualified product. It's not illegal. It just doesn't qualify for a federal government loan. When a reverse mortgage is made and it qualifies under the Federal Home Loan Board, the lender, the borrowing institution, has a guarantee from the government that if that loan fails, the lender gets paid back by the government. You see the importance of that? Now, a loan made by ABC Savings in San Francisco, and they're selling you a reverse mortgage, the terms are all the same, but they don't have a guarantee they're going to get their money back. And because the risk is higher, so is the rate of interest that they're charging. And a lot of other things do not comply with the federal regulation. They still have a right to sell that type of product. And
Had a question come in, Dick. Can you pay the reverse mortgage interest cost monthly to avoid reducing the equity any further?
you can pay anything monthly.
Mhm.
You have, if you get a stock dividend every 6 months and it's $1,500, you can go in and tell the lender that put that in their escrow and pay the interest out of this every month until it's gone, or pay the principal down, which is going to reduce your interest costs. A reverse mortgage is what's called an open-end mortgage, which means that the terms are set, but there's no requirement that you cannot pay additional funds into it to reduce the amount that you owe. And that's a good point, Mike, because some people say, well, we're doing the reverse mortgage now because we've got an inheritance coming in 5 years. And we can't afford to wait 5 years to get that inheritance because of our financial situation. But 5 years down the road, we're gonna pay everything off. That's why I say each and every individual situation bears looking at. And then you have to determine what the ability of the borrower is. Now, I might add this also. If you get a reverse mortgage from a federally insured lender, one of the terms in the mortgage that probably you may not notice or may not be brought to your attention, but as long as you occupy, and you must occupy the property. Now, you can go to Florida for 3 months and come back, because your Florida home, according to the law in the state of Wisconsin, is not your primary residence. As long as you're paying taxes and living up here more than 1/2 of the time, that's your primary home. But if you let your home fall into disrepair, the roof caves in on the garage, the siding falls off, your plumbing is bad, the sewer backed up, whatever it is that is a substantial threat to reduce the value of your property, can force a foreclosure by the lender. And what that means is that you must maintain that home in a habitable, so you have to be able to habitat it and take care of it so that it remains with its value, is not being decreased. Now, how does the lender know that? The lender has the right in the mortgage to send someone out at their schedule at any time for any reason. This will be in the terms of the mortgage, to make a visual inspection. So in other words, a neighbor calls and says, I understand you've got the mortgage on my neighbor's house, and do you know what a dump it's turned into? That's a signal to the lender, I got to get out there, But that is another term that you agree to keep the real estate in a proper valued position. You can't let it get run down.
How does it exactly work when you go to get one of these? I mean, do they just hand you a bunch of cash after you sign the paper and then they just keep tacking on a little bit of interest? How does it work?
Well, it all depends. If you have a mortgage presently on it and you're paying that off with the reverse mortgage, they write a check and pay off the first mortgage. If you're just taking the cash for a car or whatever the purpose is, they'll just write you a check. Anything that has to do, they will pay all the closing costs out of the funds. Your attorney fees, your recording fees, appraisal fees, they'll pay that all out of your funds. So you don't have to come up with anything out of your pocket.
And are they going to tell you, like Connie was saying earlier, a lot of people, the reason that they're looking at these is because they simply don't have enough income. Will the counselor tell you, hey, look, you just don't have enough income, you need to move, find a little smaller place, I mean, here in Madison, cost of living is through the roof, you know, housing prices are crazy. Grandma can't stay in her house anymore, you know, and so what do you do in a situation like that?
Well, you got to look at each and every situation. If grandma's living in the house and she doesn't have cash flow to pay the taxes and insurance and the upkeep on it, if she's got $80,000 in equity, she should be able to stay there and work out a reverse mortgage so she doesn't have any more cash flow going out. She doesn't have to pay for it because grandma says 5 years from now, I'll probably be in a nursing home anyway, and the house will be sold. That's why it's important that the counseling be done, because it's that point that the person might well be told that you don't qualify. And here's the reason why. That's the most important step, because once you get to the point that someone qualifies you by counseling and you get into the reverse mortgage procedure, you fill out the application and you get the ball rolling. It's a little too late to just say we changed our mind, although until you sign the final mortgage, you can walk away. But you're going to have some costs associated that have incurred because of your intent to get the mortgage.
Do these reverse mortgage lenders, do they compete on the basis of closing costs? Is there anything like that? I mean, that's a common competitive factor for other lenders, right?
There are lenders out there who will tell you that they include the closing costs in the mortgage, so you don't have to pay anything. I can guarantee you there are no lenders out there that pay it out of their own pocket. They're going to pay it anyway, but you don't have to pay it up front. That's one question people ask. No, we're going to have to come up with $600-700 for an appraisal, et cetera, et cetera. Don't worry about that. We'll take it out of the closing. There's really nothing wrong with that, because it's just being tacked on to what you're going to end up owing anyway. My firm belief in when you're dealing with an elderly person, when they walk in and see you and say, "Oh, I've got all sorts of problems. My son-in-law ended up in prison and he had a $50,000 fine, and we're the only relative. We'd like to help him, but we don't have the money. All we have is we own a house and it's paid for. What do we do?" Once the process starts, it's fine. It's that key element of initially going in and talking to a lender and getting to the counselor, the financial advisor who will sit down with you and explain exactly what is so important once you get this loan. Once you get past that point, you're in pretty good shape.
So in your experience, what are the most common reasons somebody would get in trouble? You know, this would be a bad thing for them.
The most common reason a foreclosure occurs in the reverse mortgage market is failure to pay real estate taxes.
Mhm.
And, you know, I guess we're pretty fortunate. I live in Stoughton. Our tax rate is, you know, what it is. And what happens is that if let's assume you're living in Chicago, Mike. I use that because I have relatives living down there. If you live in greater Chicago, within the city limits of Chicago, I can tell you this, that the city of Chicago passes on the burden of expenditures that they do not have money budgeted for to the realty people. Corporations owning businesses downtown, buildings, etc. But if you happen to own a home on Halsted Street, 3 blocks from the business district, boy, you know, your taxes can go up each and every year. So that's the main reason, is that people say, I had no idea, you know, my taxes are going to go up that high. I don't have the cash to pay it. One of the other reasons for foreclosure is what we're going through right now, like unemployment and the inability to earn an income, which is not, you have no control over. You know, I have a substantial amount of friends that are families that used to own restaurants in and around Madison. And I have 15 friends that no longer own a restaurant that had 20 to 40 people working for them. And one of the hardest decisions was to let those people go because his restaurant was not making any money and he had to close it. These are people that had been, you know, 8-10 years there, and they were relying on that paycheck to pay the car payment and the house payment or the rent. The federal government allows relief for a possible foreclosure based on facts which are not attributable to the lender. So what I'm saying is that what it amounts to is you make a mistake, you didn't know what you were doing, or you just downright didn't pay, you're going to get foreclosed. But there are reliefs out there that would forestall a foreclosure until everything got worked out, because it was no fault of your own.
Are these fixed rate or variable rate loans, the reverse mortgages?
Or most of them are a fixed rate.
Mhm.
And the reason I say that is a variable rate has to be tied to an index. The government says you have to tell the person what they can follow to see where the rate might be. What's happened in the last 3 years or so, interest rates have bounced around from very high. We just came through a period of very low borrower rates. Lenders have gotten out of the variable rate because the history over the last 18 months to 30 months has not been in their favor because rates have been too low. They're a business.
Yeah. I was wondering, given that, you know, inflation has suddenly popped like crazy, you know, and we expect that interest rates are eventually going to start rising. You know, if you're on a variable rate mortgage, you don't know what you're going to get stuck with in the future.
Well, there are other things you should be concerned about. Some variable rate mortgages have a limit to what the variance can be. They cannot raise it more than 1.25 of points over a period of 30 months. Same thing goes, they want protection on the downside too, is they will not go below the rate over the next 30 months. So they're, you know, but at least you have an idea where you're going to be.
A little idea, yeah. You're right. I overstated that a little bit.
Yeah.
Who else has questions? I mean, we have a great group here. Feel free to unmute yourself and chime in. Connie made a little remark here at the end here. She said, much like a viatical settlement on a whole life policy where you can receive a discounted portion of the face value, reverse mortgage could be used for end of life costs, right? Pay for your burial, I guess, and other things. I guess if you don't need that equity, that's one way to use it.
Well, you know, I always look at it this way, Mike. Equity is something that you have no control over mostly. Unless you can determine what property values are going to be in your area and how much they're going to rise over a certain period. You know, we went through a period of time where, well, the term that we used was many mortgage holders, many individuals who had mortgages in the mortgage market were underwater. They went out and borrowed 80% of the appraised value when values were high. And then when the values bottom dropped out, they ended up owing, they lost that 20% cushion. And in fact, they owed more than the property was worth that they could sell it for and satisfy the mortgage. You don't want to get in that situation.
Right. Right. Let's see here. Dick, you mentioned that you had, there's a brochure or a document from the Consumer Financial Protection Bureau that you mentioned. Let me pop that up here real quick. If you're interested in this topic, this brochure from the CFPB is really terrific. You have a reverse mortgage, know your rights and responsibilities. I'll include that link to it when I send everyone the recording of this. And in the meantime, if you're interested in getting it, this is pretty easy to follow. Also, get on the newsletter list for the CFPB. We had a presentation by a lady from the CFPB last month at the Triad conference, and she was fantastic. They do a lot of great work for protecting people who are, you know, working with financial people. So CFPB and their newsletter list, that's great. Any other questions at all? Okay, Dick, well, I just want to thank you so much for lending us your expertise. We really appreciate it. And thank you everyone for joining. We'll see you next month. All right, next month we'll be talking about some great things too. So see you next month.
Good program. Thanks, guys.
Thank you, everybody, for attending, and I hope I gave you some answers. And you know, anything that you can do for the elderly people to keep them from getting in trouble is important.